All attendees are in listen-only mode.
Good morning. Welcome to our webinar on planning for the inevitable, the exit from your business. My name is Amy Longmore, and I will be introducing your presenter today, Roy Johnson. Roy has over 40 years of experience encompassing corporate financial management, business consulting, entrepreneurship, education, investment banking, and mergers and acquisitions. Roy was the Director of Corporate Financial Planning for a Fortune 1000 company, the co-founder of 2 value-based strategy consulting firms, a principal in a management buyout, and the author of several articles and a book on shareholder value. Please type any questions you may have during the webinar in the chat box to the right-hand side of your screen. We hope you enjoy the webinar. Roy, are you ready to begin?
I am, and thank you, Amy, and thank you all who are out there. I understand we have several business owners who are attending this webinar this morning, and hopefully the next 30 minutes will be useful for you, in terms of your thoughts about your future. So we're going to talk about the inevitable situation, exit from your business, not something everybody wants to think about, but is something that's going to happen. And it is inevitable at some point in time. Every owner is going to exit or liquidate their business or somehow go through some kind of a transition or a transaction. And, these questions that are posed here on this slide really deal with the overriding issue is who's going to be in control. Are you, the owner of the business, going to be in control of the exit or the transition? Or is the exit or transition going to be in control of you? And, if you think about it, that's a fairly important question. And some of the factors to consider here are when is the optimum time, to exit or liquidate, to whom, outsiders, insiders, family members, and so forth, how to do it, and for what type of consideration. So these are some of the key questions that we'll certainly try to get into during our time together today. This is an interesting perspective, and it's something that has had a history. Don't know if it's going to continue as we move towards the year 2020, but it's been a very interesting situation during the last 4 decades, from 1980 through where we are now, that the middle years, the 83 to 88, 93, 98, 2003 to 08, and really 2013 through where we are now, have been good years for sellers. Buyers are there with access to capital, as opposed to the 80, 90, 20, 2010 era, which we've had a kind of a deal recession. So again, we don't know if this is going to continue. It's very difficult to predict it, but if the past 3 years do continue, then 2017, 2018 should be good, and just something that you may want to put in your think tank and give some consideration to. The source of this is Rob Slee, who is an outstanding individual. I've had a chance to meet him personally. The book that this comes from is probably a little too deep for most of you. It's like an encyclopedia about private capital markets. And we read it here because we do a lot of work on valuation. But I would encourage you to take a look at another book that he has written, which is Time Really Is Money. This is an outstanding read. It's easy. It's relatively short and brief, very concise, and a very good read for business owners like yourself. So I encourage you to take a look at that book by Rob. So what's at stake here? For some, maybe all of you, it's the largest asset that you possess. It's your primary source of income. And, it gives you some certain perks and luxuries and source of pride and status in your community and things of that nature in terms of what you built over, I would assume, many years of being in business. So if these above comments describe your situation, then you really should consider planning, for this eventual situation. And my suggestion, you do this sooner rather than later. So this is a little bit of a graphic profile of what a lot of business owners encounter. Most of you probably have some stocks and bonds and some cash. You may or may not have real estate. Some of you may own the facility or the property in which you operate your business out of, and some of you may be a tenant. So the real estate situation is usually a question mark, in terms of the private business owner. But for some of you, maybe all of you, I don't know, depending on your personal situation, the wealth that's tied up in your business could be your greatest asset. And this is a very illiquid asset. And as opposed to, the stocks and bonds that you can trade, on the click of a button or on your phone now, actually, or a call to your broker, the business asset is relatively illiquid. Business sales typically only occur once. And so it's very important that they be done correctly and be very well planned for. So, and what we find in our travels in dealing with, many business owners like yourselves, is that some of these folks do not view the business as an investment. It's more of a job, it's a career, it's kind of a lifestyle situation. And we encourage everybody to view the business as an investment and always be running it as though you're going to sell it. So some of the barriers that are out there, you may be experiencing some of these, is that you are the business. So who could possibly take your place? And what are you going to do after you leave? How are you going to fill your days? I'm a golfer. I'm about the age, if not older than many of you, but there's only so many rounds of golf you can play, or if you're a tennis player, how many games of tennis you can play. So, and the other questions are things about your status in the community and how your family and friends are going to react, and lifestyle considerations, and so on and so on. So there are some barriers, and they're very real, and nobody's trying to minimize these kind of situations or these barriers. But for those of you who can overcome these, what I'd like to go through now is a 5-step process to either exit or liquidate, or somehow transition the business. So the first thing you want to do is to establish exit goals. These are very personal for you and what you want to achieve. And it's really analogous to hopefully what you did when you started the business, establishing some business goals, for the company, and hopefully some goals in terms of what you want to achieve for yourself. So it's really just a natural follow-on to what hopefully has been a goal-setting process that you've been engaged in throughout the time that you've owned and managed your particular business. Next step is to determine your readiness. And that is done from a financial and a mental perspective. The next thing you want to do is to identify the type of exiting owner you most resemble. And we're going to go through that in a minute. Fourth, talk about your exit options and try to help you focus on the one that may be most suitable for you. And then the last step here, which is obviously very important, is to understand the value that could be associated for the option you choose. And one of the interesting situations about private companies is that they typically have a range of values, and we'll go through that in terms of the type of buyer that's out there. So this whole process, if it's followed, gives you a framework to execute the plan, and hopefully enables you to achieve, the goals that you want for yourself as you move down the road here and protect the wealth that you've built up over the years. Okay, so first, you want to establish some goals, and your considerations, are financial ones, personal in terms of lifestyle, family, any professional type goals that you may have. This gets into a situation, do you have family members who are involved in the business, colleagues, who may have a key role in who's going to replace you and those kind of things. Hopefully you don't have any health issues, but if you do, obviously, those need to be taken in consideration. So these are very personal. They really, need to have a lot of thought. And the key is to get clarity about what you most desire in the future. And that's the key aspect of this whole situation. Really getting clarity, try to get specific about some of the things that you really want for yourself. The next second step here is to determine your readiness. And as I mentioned, this we look at from both a mental and a financial perspective. And we use this little matrix here to try to help you position yourself. So if you look at the positioning here, we've got, if you look at the quadrant that's to the far right, this is the type of owner who has a very high degree of mental readiness to get out. They're kind of fed up with the business. They're burned out, maybe had enough and just want to get out. And they don't have a lot of money. So they really want to leave, and the sale of the business is obviously, pretty important to them. If we move straight upwards to the upper right, we have an owner who wants to get out, but he's in pretty good shape financially. Moving to the very lower left quadrant, this is the owner who really likes his business. He's connected to it, or she's connected to it, loves to come to work, and also doesn't have a lot of money. Would have difficulty living independently outside of the business. And then on the very upper left, we have the type of owner who has money and but still loves the business. So what I would encourage you to do, and there's absolutely no obligation on your part of doing this, there is a business exit readiness index survey that you can take. We call it the BERI, B-E-R-I report, and we offer that as a very complimentary service. You will not get harassed by us, I assure you, for taking it. We actually have an incentive to get as many owners as we can to take this survey, because it builds up our database in terms of trying to positioning owners and so forth. So it's the BERI report. You can contact Jen Ferguson, who I think you registered with, and she can get you set up. Take you about 15 minutes or so to do it. It's a 20-question survey, very easy to take. You do it online. So let's get into mental readiness here. And this will just give you some idea of the questions in the BERI report. So when you're exploring your mental readiness, you're really trying to get into how involved are you in the day-to-day operations. And then to come back to something I mentioned at the outset, do you really view the business as an investment or more of a job and a lifestyle situation? And again, these are some of the issues you're going to deal with and some of the questions you're going to be answering, as you go through this part of this survey. As we get into financial readiness, some of the key issues and questions you need to, determine is how are you going to live? Is it important for you to live the way you do now outside of the business? Do you have any other sources of income? Do you have some perks and benefits? Are you a member of a nice club that you enjoy and, that the business may pay for? And, and obviously at the end of the day, how much this business is worth and what is the government going to take and what's going to be left for me. We have an old saying here that we repeat over and over again, that it's not what you get, it's what you keep. So after we get through the financial readiness, which is a very important part of this process, we get to what's called a value gap. So you may have some liquid and other income producing assets out there, and they may or may not satisfy the way you want to live, post-retirement or post-transition of the business. And for most owners, there's what we call a value gap. So there's something that's needed between what you have and what you need to have and maintain the lifestyle that you're choosing for yourself. And we call that a value gap. The next third step is to identify yourself, in terms of the type of business owner you are. And there's 4 types of exiting owners. The first one, who has a very high mental readiness and not a lot of money, is the type of owner who wants to get out, and they need to get out at the highest price. And they want to do it sooner rather than later. The next one is rich, or certainly well off, doesn't have to, but he or she is really ready to get out. They've had enough. They may be burned out. They may be getting to an age, where they feel it's time to turn the business over to somebody else. And that's our second one. Actually, this third quadrant here is based on the results of this Berry survey that I hope you'll take. Actually, the majority of owners who take this survey find themselves in this quadrant, stay and grow and build wealth. So I don't know where you individually might fall, but this is the owner who enjoys his or her business, does not have a lot of money outside the business, and maybe has a 3, 5, maybe more in terms of time frame horizon, and really needs to stay and grow this business and build wealth. And then finally, we have the individual who is well off, could maybe leave tomorrow, and has enough outside income to support himself or herself, but just chooses to work, likes what they're doing, loves the business, and is very closely connected to it. So these are the 4 types, and what the Berry report will do is to help you kind of survey yourself and do some self-reflection and really put you into one of these categories. And that's very important in terms of moving forward with any kind of an exit plan. This is really critical, a very important first step. The 4th step in this process is to learn and study your exit options. And you really have 5. You can get engaged in an employee stock ownership plan, an ESOP. I'm sure you've heard about that. You can have a management buyout, in which you basically sell or transition the company either in total or in part over to your key managers. You could have a gifting program or a family transfer, particularly if there's an estate situation to deal with. And then the 4th type of option is what's called a private equity group recapitalization. We call this a PEG recap. You have to be of a certain size to do this. Usually you need to have about a business that's doing at least $10 million of revenue, maybe $1.5 million, $2 million of EBITDA for the PEGs to get interested in you. I'm sure you've heard of these private equity groups. There's thousands of them out there. I think we have 2,000 in our database alone. And this can be a very interesting and rewarding kind of a situation, but you have to be a big enough company to be able to attract the attention of a private equity group. And then finally is the sale of a business to an outside party. So in summary, the first 3 are what we call internal transfers, and then the number 4 and 5 are what we call external transfers. And as you might imagine, there are advantages and disadvantages to each, similar to everything else in business, and there are trade-offs to be evaluated. Now, what I will do is, if we have time, and I'm not sure how close we're going to get here, but if I have time, before we end here at 8:30, I will come back to this slide and I will give you a little bit more detail in terms of the advantages and disadvantages of each of these. So let's move on here, and then hopefully we'll have a few minutes to come back and talk about these a little bit more, because they're pretty important. In terms of looking at these options and fitting this into our chart, the owner who has a high mental readiness and not a lot of money is going to sell his business. And it's going to be an outside sale. So it's going to be the sale to a third party. Virtually is the only option that this owner has. The one who's rich and ready to get out has some options because he has money. So you could do a gifting program, you could do an ESOP, or you could sell a business. The one who is on the low quadrant, lower left, if you're big enough, you could do a PEG recap. This is a way to take a few chips off the table, still maintain either a minority or majority stake in the business, You could do an ESOP, or you could just stay and grow it and build your wealth and think about doing some type of a transaction down the road. And then finally, if you have a high financial readiness, low mental readiness, you might want to think about a management buyout. Again, you could sell a part of the company to your managers, minority or majority stake. You could have a gifting type program, or you could do an ESOP. So depending on where you fit in the matrix here, these are the most viable options that are open to you. The next and final step here is to determine, the range of values that go along with the particular option that you may choose. For internal transfers, gifting, management buyout, or ESOPs, you're either governed by, in terms of law, fair market financial value, or realistically governed by that. So fair market value follows along what is known as Revenue Ruling 59-60. It lays out some requirements in that the transaction must be arm's length. There can be no synergistic or strategic type premiums in that. And fair market value standards are literally regulated in terms of any gifting or estate tax situation and ESOPs. ESOPs is actually a defined benefit plan under ERISA, so has quite a bit of government control connected to it. From a practical standpoint, your managers are generally not going to have a lot of money, and they're not going to be able to pay you more than fair market value. So either in terms of IRS regulations or practicality in the real world, these type of internal transfers are typically going to be subject to a fair market value, which is typically the lowest of all the values you're going to encounter. When we get into the external transfers, the recaps, and the outright sale of the business, here we get into what is known as market value. And here, this kind of value goes beyond what's on the books of the company. The fair market value basically looks at the books of the company. It may make some adjustments for some of the perks, the country club membership, and maybe some excess compensation that we mentioned before, and you're allowed to have adjustments for those kind of things. But you're not allowed in a fair market value world to look at unusual growth opportunities or maybe some very unique cost synergies that may occur by you combining with a larger company. This is all part of market value. And so when we take on a client, for example, to sell, this is what we are looking for. We are trying to create basically a public marketplace for a private company and identify those buyers who truly see some opportunity beyond what's on the books and records of the company. Now, we do actually have a webinar on valuation, and I'm not sure exactly when we're going to be giving that, but it's something, if you have a more intense interest in valuation, you can certainly register for that one, or you can contact us. I'd be happy to talk to you about some of the particular factors that influence private company valuation. So in terms of market value, the PEGs, the private equity groups, will typically give you a little bit more than fair market value, but they're pretty smart people. They're very analytic, so they may see some opportunities. And particularly if you are in a industry where they're already participating, they will often pay a little bit more than fair market value. Your biggest opportunity for just pure value is with the synergistic and or strategic buyer that you get in a business sale. Synergistic buyers will look at cost savings, doing things more efficiently, and strategic buyers will look at primarily at growth opportunities that your company may provide them. So this is where you really get the biggest value, and it's just a fundamental factor of business of these two arenas here, or value worlds as we call them. So that's something about the range of value. So the key point here is that the option you choose will determine the value, at least in a relative sense, that you can get for your business. One of the very key elements here is to create what we call a transferable business. This is extremely important to buyers. So if you are considering an external sale, going beyond your internal management, people are looking for businesses that have some management depth to them. You will get a situation where with a very small company, if it's a strategic kind of a fit, this is not an issue. Okay, so a company may come in, you're kind of the business, you stay on through a transition, help them get going, and this may not be a major issue. That's typically the case for a small business. As the business gets larger, most buyers want to see a management structure in there. They want to see a situation where if the owner takes off on a 3-week vacation, that the business can run and really has a support staff outside of the owner himself. Now, we have a very powerful tool that we give to our clients, so you do have to become a client of ours to get involved in this. It's called an Owner Dependency Index, and this is very useful for those owners who are serious about a transition and want to plan for it. There's 8 areas that this ODI measures. It's 40 questions, and it's a really good self-analysis of kind of where you stand and how transferable your business is. But that's something that if there is some interest in talking to us, we could discuss down the road. So to conclude then, you want to execute a plan that has these elements to it. You want to have written goals. You want to write them down. There's nothing like writing something down. And you want to have a well thought out strategy that's considered the key factors and all of the interested parties that are going to be involved in any exit or transition that you're going to consider here. And very importantly, you want to think about the time frame. Is it a year, 2 years, 5 years, 10 years, that sort of thing? What is the time frame? And it should be the one that is the best one for you. So in terms of what we offer here, we have 2 plans that we offer to business owners. One is a summary plan. This is for the owner maybe of a smaller company or somebody who's just kind of thinking about developing an exit. It's kind of a software-driven program, really focuses on this value gap, does a lot of analytic work in terms of looking at your pre-tax, after-tax situation in terms of different types of transactions and what they may mean to you. So it's mostly a software-driven plan, and it's really focusing on the value gap. The full plan is for those owners, particularly those who have a large company where there's a lot of money at stake, who want an in-depth analysis and then a path forward to achieve a successful transition. So those are the 2 programs that we offer to owners in the exit planning arena. Our role is we're really kind of like the point guard on a basketball team. We're distributing the ball. And if we do it to a business sale, we'll hand the ball off to ourselves because a big part of our business is to serve as an M&A advisor on these business sales. We'll also hand the ball over to your financial or your insurance advisor, and this gets into the whole estate planning, wealth protection area. You're going to have an accountant, obviously, who's important here in terms of the tax situation, and probably a legal advisor. And there are 2 types here. One who is more on the estate type planning side. The other is on the transaction side. So that's kind of a team. So if you get engaged in a exit plan, you should think about viewing this as a team concept. And that's kind of what we do here. A little bit about ourselves. We are an exit planning M&A firm that advises business owners of firms with sales of $5 million. In terms of exit planning, you really need to have about $5 million or so to make this effort worthwhile in terms of exit planning. However, we do sell smaller companies. So if you have a business that is worth anywhere north of $2 million, we'd certainly be happy to talk to you about, the possibility of selling that business. And if you're on the other side of the coin, if you're younger and you're really trying to build a business, we have a buy-side practice where we work with businesses that are looking for acquisitions of $2 million or more. And again, working with manufacturing, distribution, technology, and B2B service companies. It doesn't look like I'm going to have enough time to go back to the exit planning options. If any of you are interested in doing this, I'd be happy to give you some insights in a phone call. You can, get my number and give me a call, and I can give you a lot of detail on the trade-offs, the pros and cons of the ESOPs, the MBOs, the gifting programs, and the external sale situation. So with that, I'm going to turn it over to Amy to get us wrapped up here and talk about our next session.
Okay, thank you, Roy. I would like to take a moment to thank everyone who attended our webinar today. And as you can see, our next webinar is scheduled on June 8th from 11 to 11:30 Eastern Standard Time. And the topic is 9 ways to leave your business. You may register on our website at touchstoneadvisors.com or watch for an email invitation. We hope you will join us again, and this concludes our session for today. Thank you.